Right now, millions of people across the UK are receiving pension payments that look slightly different from last month. Some are higher. Some, confusingly, are lower. And a significant number of people are entitled to money they are not receiving, not because anything has gone wrong, but simply because nobody has walked them through what changed in April 2026 and what it means for them personally. That is exactly what this video is going to do. I am going to take you through every change that came into effect this month, the state pension uprating, pension credit recalculations, housing benefit interactions, managed migration deadlines, and some lesser-known entitlements that have quietly opened up. And I am going to do it clearly, without the alarm, without the jargon, and without burying the useful information under 10 minutes of build-up. By the end of this video, you will know exactly what your April payment should look like, whether your pension credit has been calculated correctly, which deadlines are live right now, and a set of specific steps you can take today to make sure you are not missing anything you are owed. Let us start with the numbers, because that is what most people need first. The state pension uprating for April 2026 is now live. Payments at the new rates are either already in your bank account or will arrive within the next week or two, depending on where your payment date falls in the cycle. If you are on the full new state pension, that is, if you reached state pension age on or after the 6th of April, 2016, your new weekly rate is approximately £230.25. That is an increase of around £18.70 per week compared to the previous rate. Over the course of a full year, that works out to roughly £972 in additional income. If you are on the old basic state pension, meaning you reached state pension age before April 6, 2016, your new full weekly rate is approximately £176.45. That is an increase of around £14.35 per week. Now, there is something worth understanding about how the payment transition works, because it catches people off guard every April without fail. The DWP pays the state pension in arrears. That means you are always being paid for a period that has already happened, not for the period ahead. When the uprating kicks in at the start of April, the timing of your personal payment date affects exactly how your first higher payment is calculated. If your payment date falls partway through the first April cycle, you may receive a blended amount, part calculated at the old rate, part at the new rate, depending on where the 6th of April sits relative to your schedule. This means that your first April payment might not match either the old weekly rate or the new weekly rate exactly. That can look alarming if you are not expecting it. It is not an error. It is simply how the transition is processed. What you should do is check the award letter the DWP will have sent you in March. That letter should set out your new rate and give you enough information to understand what your transitional payment will look like. If the number in your bank account does not match what you would reasonably expect based on that letter, then it is worth calling the pension service on 0800 731 0469 to ask for a breakdown. Do not wait weeks to do this if something looks wrong. Overpayments are recovered and underpayments need to be flagged. The sooner a discrepancy is identified, the simpler it is to resolve. Now let us talk about pension credit, because this is where April 2026 gets more complicated and where the consequences of not understanding what has happened can be significant. Pension credit is a means-tested benefit designed to top up weekly income for people below a certain threshold. If your total weekly income falls below approximately £227 for a single person or £346.60 for a couple, pension credit makes up the difference. When the state pension goes up in April, your pension credit entitlement is automatically recalculated. For most people who receive both, the net effect is roughly neutral. The state pension rises by £18.70, the pension credit element reduces by a similar amount, and the total weekly income stays roughly the same or ticks up slightly because the pension credit minimum guarantee threshold has also increased this year. But there is a group of people for whom April 2026 has introduced a more complicated picture, and I want to be very clear about who that is. If you receive pension credit and you also receive housing benefit, then the interaction between those two things this April is worth examining carefully. Here is why. Housing benefit entitlement for pensioners is linked to pension credit in a specific way. If you receive the guarantee credit element of pension credit, you are generally entitled to maximum housing benefit, full coverage of your eligible rent, subject to local limits. But if your income sits above the pension credit threshold, housing benefit is calculated on a different, tapered basis. The more income you have above the threshold, the less housing benefit you receive. Now, for most people, this interaction has always worked in the background without issue. But there is a narrower group, people whose income sits very close to the relevant thresholds, for whom the April uprating has had an unexpected knock-on effect. In some cases, the state pension increase has nudged total income fractionally above a threshold, which has reduced pension credit entitlement, which has in turn affected housing benefit in a way that is larger than the original state pension increase. On paper, someone in this situation is receiving a higher state pension in April 2026 than they were in March. In practice, when housing benefit is factored in, their total monthly income has fallen. This is not the intended outcome of the uprating. It is an edge case effect of how multiple means-tested systems interact. But it is real, and it is affecting real people right now. If you receive housing benefit and your April payment looks lower than you were expecting, the thing to do is contact your local council's housing benefit team, not the DWP, and ask them to walk you through the recalculation. Ask specifically whether the change relates to the state pension uprating feeding through to your pension credit assessment. If you believe the result is incorrect or the calculation has been applied in a way you do not understand, you are entitled to request a formal reconsideration. That process is free, and it is worth using if something does not add up. Let me turn now to something that many people in this situation do not realize, which is that April 2026 has also opened up new entitlements for a specific group of pensioners who have never claimed pension credit before. I know that sounds counterintuitive. How can an increase in the state pension make someone newly eligible for a means-tested top-up? But in some cases, it does, and the reason comes down to the difference between income thresholds and how different components of pension credit interact with different types of pension income. The situations where this is most likely to apply are these. First, people who have recently experienced a change in circumstances. A bereavement, a partner reaching state pension age, a change in caring responsibilities, a move to a different property, any of these can shift the household income assessment in ways that affect pension credit eligibility. Second, people who receive disability benefits alongside their state pension. Pension credit has a disability element called the additional amount for severe disability, and changes in how disability benefits are being assessed this year have brought some people into entitlement for this element for the first time. Third, people who have a significant additional state pension component alongside their basic entitlement. The interaction between additional state pension, occupational pensions, and means-tested benefit calculations is genuinely complex, and it is not uncommon for people to have incorrectly assumed, often for years, that their total income puts them above any pension credit threshold when a proper calculation would show otherwise. The reason this matters so urgently is that pension credit can be backdated, but only by 3 months. If you are newly eligible and you do not claim until June, you will lose the April and May entitlement permanently. The backdating window is not indefinite. The quickest way to check is to use the pension credit calculator at gov.uk. It takes about 10 minutes. If the calculator shows you may be eligible, the next step is to call the pension credit claim line on 0800 99 1234. The call is free, the assessment is free, and if there is an entitlement there, they will help you start the claim. There is a scenario that illustrates this well, and I want to share it because it is the kind of situation that is far more common than people realize. Think about a man in his early 70s, let us call him David, who lives alone in a rented flat, worked in the public sector for nearly 4 decades, and retired at 67. He receives the full new state pension plus a defined benefit pension from his former employer of around £95 per week. His combined weekly income before April 2026 was approximately £311. David has never claimed pension credit. He looked at his employer pension income years ago, assumed he was well above any means-tested threshold, and never checked again. That assumption was reasonable. But it may no longer be accurate. There are 2 things working in David's favor that he does not know about. First, Pension credit eligibility is not calculated purely on total income. It accounts for housing costs, disability, caring responsibilities, and other factors that can lower the effective threshold for his circumstances. Second, his local council has updated its council tax reduction scheme this year in a way that extends eligibility to pensioners in his income band. At his income level, he may now qualify for a 40% council tax reduction, potentially worth over £700 per year. Nobody has told David any of this. His council sent a general notice about the scheme change in January, buried in the council tax demand letter. He filed it away without reading it closely. David is not unusual. He represents a substantial group of pensioners across the UK, people with a small occupational pension who have ruled themselves out of means-tested support without ever properly checking, and who are sitting on unclaimed entitlement that could meaningfully improve their financial position. If David's situation sounds familiar, the answer is simply to check. The worst outcome is confirmation that you do not qualify, which at least replaces assumption with certainty. Now I want to address something that is genuinely time-critical, and I want to do that calmly but clearly because the deadline is real. The DWP's Managed Migration Program, the process of moving people from legacy benefits onto universal credit, has a new cohort of people whose response deadlines are landing right now. If you received a letter from the DWP in late February or March telling you that a legacy benefit is coming to an end, income support, old-style employment and support allowance, or legacy job seekers allowance, and instructing you to claim universal credit, that letter contained a specific deadline. For people who received those letters in that window, the deadline is either imminent or has already passed. I want to be straightforward with you about what happens if the deadline passes without action. Your legacy benefit stops. Not paused, stopped. And re-establishing it, or completing the universal credit claim after the fact, is a more complicated and slower process than doing it before the deadline. If this applies to you, call the Universal Credit Helpline on 0800 328 5644. Tell them you have received a migration notice and that you need support making your claim. If the online application process is difficult for you, and for many people it is, ask specifically about completing the claim by phone or in person. There are provisions for this. You are entitled to use them. If you are supporting an older relative and you are not sure whether they have received one of these letters, it is worth asking them directly. These migration notices do not always look as significant as they are. People assume it is routine DWP correspondence and file it away. It is not routine. It needs a response. Before I move to the action steps, I want to address one more change that is happening quietly in the background this April, and it is one that could actually benefit a meaningful number of people watching this. Many local councils across England have updated their council tax reduction schemes for the 2026 to 2027 financial year. Council tax reduction is means-tested support that reduces how much council tax you pay based on your income and circumstances. Unlike many benefits, it is administered locally, which means the rules vary between councils, and changes to those rules do not come with a national announcement. Some councils have extended their schemes to cover people at higher income levels than before. Some have changed the taper rate, how quickly the reduction decreases as income increases. If your council has made changes that expand eligibility and your income sits in the range that is now covered, you may be entitled to a council tax reduction that you were not entitled to last year. This is worth checking specifically because it does not require you to be receiving any other benefit. It is a separate assessment. And the income thresholds vary enough between councils that assuming you do not qualify, particularly if you checked a few years ago, is not reliable. Go to your council's website, find the Council Tax Reduction or Council Tax Support section, and either use their eligibility checker or contact the benefits team directly. It takes a short amount of time, and the financial value can be substantial over the course of a year. Here is everything I want you to take away from this video, laid out simply. Check your April state pension payment. Full new state pension should be approximately £230.25 per week. Old basic state pension should be approximately £176.45. If what has arrived looks wrong, lower than expected, or an unusual amount, check your March award letter first, then call the pension service on 0800 731 0469. If you receive pension credit, check that your April payment reflects the new recalculation. In most cases, the total should be similar to before or slightly higher. If it has dropped in a way you cannot account for, call the Pension Credit Helpline on 0800 99 1234 and ask for a full breakdown. If you receive housing benefit and your April payment has reduced, contact your local council's housing benefit team, not the DWP, and ask them to explain the recalculation. You have the right to request a formal review if something does not seem right. If you have not checked pension credit eligibility in the past year, go to gov.uk and use the pension credit calculator. 10 minutes today. Entitlement can be backdated only 3 months, so do not delay. If you received a DWP migration notice in February or March and have not yet acted on it, call 0800 328 5644 today. This is the most time-sensitive item on this list. And finally, check your local council's website for updated council tax reduction information for 2026 to 2027. Income thresholds and taper rates have changed in many areas. Do not assume last year's assessment still applies. The April changes this year are not dramatic in any individual sense. Most people will see a modest increase in their state pension and a relatively stable overall income. But the detail underneath those headline numbers matters, particularly for people close to thresholds, people with mixed income sources, and people who have never fully explored what they're entitled to. The consistent pattern across all of this is the same. The system does not proactively tell you when you qualify for something new. It does not flag when a calculation has interacted with something else in an unexpected way. It does not chase you when a deadline is approaching. That responsibility sits with you, but only if you know what to look for. You now know what to look for. Use it.